According to Warren Buffett, if he could go back in time and give his younger self a single piece of advice about investing, it would be simple yet transformative. This knowledge changed his trajectory, and it can change yours too. Stay with me until the end, because what I'm about to share could mean the difference between years of mistakes or a solid journey toward financial success. Warren Buffett. I started investing at 11 years old. Before that, I was undecided at 7, 8, or 9 years old. So unfortunately, I only actually began at 11. I bought my first stock at that age and from there tested various strategies, trying to predict the market, technical analysis, and other fancy tactics. It was fun, but not profitable. I did this until I was 19. I read every investment book I could find in the public library and absorbed every page. It was fascinating to me, but I didn't have a structured method. I was just searching for something to guide me. I believed that small patterns in charts could tell me what a stock would do. It was kind of crazy, but since everyone else was doing it, I thought I should too. Sometimes I would turn the chart upside down, and it still didn't help. In 1949, I read The Intelligent Investor by Benjamin Graham. I had never heard of him before. The book has only 2 fundamental chapters, but they completely shaped my investment philosophy in 3 ways. These principles are so basic and straightforward that it's hard to believe in their importance. But just like the 10 Commandments are simple, these principles are too. The first principle is that a stock represents a fraction of a business. You can't see a stock as something isolated. You need to evaluate a company and divide it by the number of available shares. What really matters is the quality of the business you are acquiring, its economic characteristics, who its competitors are, and how the company is managed. When I was 11 or 12 years old, I knew almost every stock ticker on the New York Stock Exchange, but I understood nothing about the companies behind them. The second principle Graham teaches is how investors should react to market fluctuations. In Chapter 8, he introduces the concept of Mr. Market, a brilliant metaphor for market behavior. Most people interpret stock prices the wrong way. They feel optimistic when prices rise and discouraged when they fall, as if the market exists to guide them. Mr. Market is a fictional business partner who every day offers to buy your share of a company or sell you more shares at the same price. In the real business world, nobody does this. If you and I owned a gas station together, and I demanded that every day you offer me your share at the same price I offered mine, you would be at a disadvantage. In the stock market, this partner is completely irrational. He's a manic depressive who swings between extremes, offering ridiculous prices, both high and low, without any logic. You don't have to pay attention to him, except when it benefits you. That could be once a year, once every 5 years, or just for a single stock among thousands. The market doesn't exist to instruct you, but to serve you when it's convenient. The third principle from Graham's book is the margin of safety. If you're driving a 9,800 kilo truck and encounter a bridge with a 10,000 kilo capacity, what do? Do you proceed or do you find a safer bridge? Nobody knows the exact limit of safety, so it's always wise to have extra margin. In the stock market, you should wait for opportunities that scream at you, where the risk is minimized by the margin of safety. With these 3 principles, you can build your entire investment strategy. They are the foundation, and without one of them, your investment philosophy is incomplete. The most important thing over time, especially when dealing with large sums of money, is to understand the business behind the stock. Now imagine you were given $1 million and had 1 week to choose 3 private businesses anywhere in Tennessee to invest in. You wouldn't be able to sell them later. You'd have to hold them forever. How would you evaluate these businesses? You'd probably look for companies with a lasting competitive advantage. You wouldn't buy a Burger King franchise just because there's no competition within 10 miles, because in a short time, McDonald's and Wendy's would move in. Instead, you'd look for businesses with a sustainable competitive advantage, something with a moat around it, protecting it from competition. This could be a strong brand, a patent, a prime location, or a powerful concept in the minds of consumers, like Coca-Cola. Coca-Cola is present in happy moments. At the movies, at Disney, at the World Cup final. They want to associate their brand with happiness. And even if another company sells a slightly cheaper soda, people will still buy Coca-Cola. That's a competitive advantage. Additionally, you need honest and competent management. The best businesses are those so solid that even a bad manager can't ruin them. As Peter Lynch says, buy a business so good that even an idiot can run it, because sooner or later, an idiot will. Finally, you need a reasonable price. If you had 1 week to analyze businesses in Tennessee, you would quickly eliminate many obvious bad choices. This ability to discard poor opportunities is essential. The stock market works like chess. When Bobby Fischer played against Spassky, computers could calculate millions of moves per second. But humans had an advantage. They could eliminate most bad moves without calculating them. In the market, you also need to eliminate bad investments to focus on the few truly valuable opportunities. If my life depended on choosing 10 Dow Jones stocks that would outperform the market, I would start by eliminating the worst companies. That's easier than trying to guess which ones will be the best. Did you enjoy the video? Like and subscribe for more content like this.